Anything, Adam? Todd? A little bit? No, I mean a little loud. I was looking for some dancing.
Yeah,
I was looking for some dancing. I think I have the wrong guys here for a dance. So, I'll just cut it there. That was our new intro music. I hope you liked it. We scrapped the old music from the last 5 years, but what we still have, great, great topics and great panelists. Welcome to season 5 of the Profit Power Hour, presented by Profit Coach. Profit under pressure. Which fee models still work? I think a very timely topic here. I'm hearing a lot of property managers talk about this. I'm seeing it on the back end in the data, and so really good time to have this conversation about fees and experience and churn and kind of making the correlations there and learning more about what we can do about it. Sam Edinger is pumped. Glad to hear that. Glad to see you here. My name is Brad Johnson. If you do not know me, I'm the CEO of Profit Coach. We help property managers expand their entrepreneurial freedom by building highly profitable, self-managing companies, and I am your host with the most of this Profit Power Hour. Okay, I have a couple special guests for you, but first, as I often show you pictures of my adorable children, usually family photos, I thought I would show you this picture of my 1-year-old daughter. We got 7 inches of snow all at once in January. It was the most we got in 37 years. Biggest snowfall in 37 years. And so I zipped that little one up and I stuck her in the snow, and she thought it was a great time. My other kids, they had a good time too, but it wasn't quite as good of a picture as this fat little baby. All right. On to our panelists. You know these men. They have been on this show before, repeat guests. First of all, Todd Ortscheid, affectionately known as Todd O, President and CEO of Revolution Rental Management in the Atlanta area, partner at PM Assist, and the one who got us into all of this mess with the fees. And so he's going to help us navigate this conversation. And I'm grateful that he's here. I'll let him introduce himself a little bit more in a moment. And Adam Willis, president of Nestwell Property Management in the Salt Lake City area. Longtime Profit Coach client, one of our first, one of our favorite, but don't tell the rest of our clients. Okay, questions. Drop them in the Q&A if you've got them. And then, of course, please continue to use the chat to say whatever you like. Right now, it appears as when all of the AI bots are going to make themselves known. Thank you, AI bots. Moving along, here's our agenda. Why yesterday's fee model feels riskier today. You can dispute the premise if you like, but I am willing to say that. The relationship between fees and trust, another catchy way to put that would just be revenue and retention. And number 3, designing the business you want to run, building for scale versus building for fit. You know, if you have been here the last few Profit Power Hours, we are continuing to harp on that topic. I just think it's super important. I see most folks in the industry who write and record videos for the industry talking about that. It's really important, and I want to apply the fee conversation to that very thing, which is how do we structure our fees around the business that we want to run with the clients that we want to work with. Okay, first, a poll. In today's market, where are you feeling the most pressure? Katie, if you'll launch that poll, here's a few options for you. Longer, maybe it's all of these, so most pressure. Longer days on market, tenant pushback on fees, owner scrutiny of management slash ancillary fees, or what pressure? Not feeling any pressure. Don't know what you're talking about. So please fill out that poll. While you are doing that, I see that there's already a very clear answer to that question, but we'll see how the rest of the things come in. While we're having that poll go, let's just let Todd and Adam talk about themselves just for a brief moment. Todd, why don't you go first? Who are you? What have you done? Is that a fire you have going on over there in the corner?
It is. Yeah, it was one of my favorite possessions on earth is my fireplace in my office. I love it. It's this time of year.
Mm,
It's great. But uh,
mm,
but yeah. So I mean, I've been in property management now for I guess 14 years now. So just as long as I was a pilot before that. Now this is the year where it's my careers have matched up. And I kind of got started, as you mentioned, as a consultant a few years ago, talking about this kind of stuff. Going, teaching people about fees, revenue maximization, all that kind of stuff. So that's really kind of my my claim to fame, for lack of a better word, in property management, is doing that sort of thing. So this is my favorite topic.
Yeah, you have done an amazing job driving the revenue conversation, specifically around fees and generating revenue per unit, which is a very important part of building a profitable company. You have to have enough revenue to support the profits and the margin that you're looking for. So, thanks for joining us here. And Adam, over to you, sir.
Hey, it's good to be here. I'm having a great hair day, so I'm very excited to be on camera today. Yeah, I'm Nestwell Property Management, family owned and operated, retired everyone out. Now we manage about knocking on 1,200 doors here pretty soon. And we manage across the Wasatch Front or the Utah market. And I am a customer of the fee maxing course that Todd has generated, and I've read all the books, and I have had a really great run for the past few years, like many of you guys that are on this call, I'm sure.
Yeah, yeah, no doubt. And addressing my interesting background here, I am in a hotel room in Orlando, speaking at the Key Renter Summit tomorrow. So coming at you live from a hotel room. Not the first time, certainly will not be the last. Okay, before we move to our first topic, I want to end this poll, click, and share it with you. So here's your clear winner. Where are you feeling the most pressure? Days on market, vacancy. There's more issue there than there are on fees. Now, I would be curious to find out, and maybe I'll just ask in the chat between your let's take that one off the board for just a moment. Owner fees, tenant fees. Where are you feeling more heat? If you're driving ancillary revenue with both of those, where are you feeling more heat? So throw it in there. So a couple people already put owner fees. There's some tenant fees. Okay, so that's what I thought. We're seeing a little bit of that on both sides. All right, cool. Let's jump in. This is a screenshot from an industry publication a couple days ago. Todd, you might recognize this. Todd wrote an article on this right before the Profit Power Hour, which was very timely and very helpful. So this is how he introduced this, and I thought this was a really good way to put to frame the problem here. So across multiple states, we're seeing required upfront disclosures of mandatory fees, sometimes being included in one big amount, caps on late fees and application fees, sometimes even pet fees, scrutiny of admin fees, restrictions on total costs, attempts to target junk fees, which, as he mentions, is a wildly open to interpretation term. So, seeing a bunch of government regulation. That's what this slide is about. We're seeing all kinds of downward pressure on fees from the government. Okay, now look at this chart. This is a chart from 2025, um, November of 2025, that is the National Single Family Rent Index year over year percent change. So, and they have it listed out by price tier. I'm not that concerned about that. What I am concerned about is the trend. Excuse me. So, rent prices in November 2025 increased 1% essentially year over year. The previous year was 2.5%. And then obviously the years before that, let's not even talk about 21 to 23 because that was wild. So we saw the rents go way up and now we're seeing the increases correct. And as you can see at the very right side of that chart, we're back to a national average of close to 0%. There are some markets, obviously, that have rent decline, and then some that still have some minimal growth. But the boom on rental increases is over, and that means a lot of things, right? That means pressure. That means, lower management fees because those were going up because those are often correlated to rent prices. So government regulations, rents, and then here, this is from Appfolio, also recently released. Top threats heading into 2026, according to property managers, high occupancy rates, maintaining high occupancy rates being a concern, rising costs, delinquencies, government regulations. Okay, rents are down, vacancy is up, government is cracking down on fees. Is the party over? Is the party over? So let's start there. Here's a question for you, but I'll just start with that. Todd, is the party over? Or should we pack it up and go home?
No, definitely not. I don't think the party will ever be over in this business, but I will say that it's definitely changing. I mean, we're certainly not in that spike anymore where we saw on the chart where rents are going up 15% and it's basically the landlord's game. You can do whatever you want basically in that kind of market. I mean, we're certainly not there anymore, and that's not normal. We shouldn't have expected it to be like that for very long. So, it's not the way it was, but I mean, we still have plenty of opportunities for revenue. And as far as the question on the board, I think there is some unnecessary friction created at move-in, but I don't think it's necessarily because of ancillary fees. I think the bigger problem is the total move-in cost. I think is what we really need to be looking at, and frequently the biggest part of that is the security deposit. So I think that's our biggest area where we can actually try to deal with this problem without losing revenue and possibly even gaining some revenue from a security deposit alternative standpoint. So I think we have to change our tactics here. We got to be strategic about it and figure out, where are things going? What's the future going to look like in a few years? I don't think the game's over. It's just we got to modify the plays we're playing.
Okay, so let's hone in on that for a minute before I swing it over to you, Adam. Security deposit alternatives. Can you help the audience understand what problem that addresses and then how do those work?
Yeah. So I mean, the problem they're addressing is that big chunk of money that residents have to come up with when they're trying to move in. So I mean, we look at the poll results. I love that poll that went up because it came out exactly where I thought it was going to be, maybe even a little bit stronger, where everybody's concerned about leasing time. Days on market's like the big problem. Well, how do you deal with that problem? It's making it easier for people to move in. And the biggest problem for people is I got to come up with $3, $4, $5,000 to move into this property because I got to pay first month's rent. I got to pay security deposit. In some states, they might even want last month's rent. It's a huge amount of money for people to come up with. So what do? They go looking for an individual landlord who's not asking for all that. And, so we need to find a way to deal with that problem. And a security deposit alternative is a way to deal with that. You can create a situation where instead of having to come up with this huge chunk of money up front, you can pay a small amount of money every month instead, and it makes it a lot easier for that person to say yes to rent from you.
Yeah. Okay. That's good. That's good. Adam, how about you? What do you see? What are you seeing in your portfolio as far as friction at move-in, ancillary fees, SDAs? How are you addressing all that?
Yeah, totally. When there was that two-question poll, it was longer days and tenant pushback. I think tenant pushback is a silent signal of longer days, right? So, yeah, on its face, security deposit alternatives are totally viable, but there is just a plethora of fees that will naturally create a lot of resistance and friction. We will intentionally use like odd-end pricing and stuff like that to add cognitive load, and it just seems like a fee after fee after fee. So it's kind of like booking a concert ticket or me trying to get World Cup tickets. Here's the ticket price plus the parking fee plus the electronic delivery fee plus the whatever. And all of a sudden it's just like, it's too much, guys. And that invokes a certain feeling. They might very well be able to afford it, but you're just overwhelming them. And I think a few bad actors are causing this national attention, or certainly in Utah, where the way it's being disclosed or the lack thereof is the real friction for me, is that if you're not advertising or fully disclosing everything up front, then there's the appearance of a gotcha fee and after they've applied, and that just creates a lot of sand in the gears of trying to get that unit occupied. And that's where we really make money, is when it's actually occupied and we're generating revenue for the homeowner. So I think a simplification, total fees up front is going to be reduce a lot of that mental load or gymnastics that they have to do, or the appearance of gotcha fees, which our industry is notorious for.
Yeah. So is that something that you're moving towards or something that you guys are already doing at Nestwell?
We had some legislative pressure a year ago to move towards that. And the way we were able to strike down that bill was, hey, everybody, let's play nice. Let's be proactive and show that we're, good housing providers and fully disclosing everything up front. Delta recently did this too, where it was like you were either first Delta One, first class, whatever. But now they've broken down Comfort Plus into three or four categories, and I'm like, damn it, I love you, Delta, and I'm going to pick on Delta because I know Todd and I are both big fans of that brand, so I'm going to bring it up as much as possible, and hopefully we can have them go back to a more simple pricing model.
Yes, yes. The imagine that the Salt Lake City and Atlanta guys love their Delta Airlines. I do too, but can never get the times to line up. Todd, I'm curious, what are you as the as one of the big proponents of the ancillary fee movement and fee maxing and some of those things? You're facing these pressures as well, everyone is. So what are you guys doing as far as how you're packaging, disclosing, and showing those fees to the tenants and owners?
Yeah, well, I mean, we've always been really big on transparency on this. I've always taught that as part of our fee maxing training is that, yeah, it's okay to have ancillary fees, but no one should ever be caught by surprise by them. So I mean, that's always been big for us. So that's not a change. But what I am looking at changing, and this is what I talked about over at the Charleston conference last week, was kind of what Adam was talking about there, which was the idea of getting rid of the layering of fees, which is kind of where I think of a lot of it's not just the mental load like Adam's talking about, it's also the perception to lawmakers and regulators. And it's
Hmm.
like that Ticketmaster thing. Because I mean, Ticketmaster's got who got hit last year. Is Ticketmaster and Airbnb or who or year before? Yeah, year before now. I'm losing track of my years. It was under the Biden administration when they came out with their new regulations where they went after Ticketmaster because of it's this fee and that fee and this other fee and a fee for a fee and it's just one after another. And what I'm trying to do is kind of combine these all into just a big, a lump fee, for lack of a better word, something that we can all combine into. And what I'm probably going to do with it is just make it part of our resident benefit package. So it'll be
Hmm.
a variable benefit package fee instead of having that and then this other fee and then this other one and then they all stack on top of each other. We're just going to have the system calculate a custom RBP fee for an individual tenant based on the options that they select. And then that's like their one additional fee that they pay each month. So we're kind of moving more towards that model is kind of where I want to go this year, but I haven't quite got there yet.
Okay. Yeah, that's really helpful. There's so much going on in chat that we may end up just staying on this slide for the entirety, because I want to talk about both of those things, the fraud issue and the SDA issue. So I'm coming back to you, Todd, with the SDA. You explained it. Any SDA providers you can recommend? I think you do yours in-house. I know you have some content around that. Can you tell people more about how to find or create these STA opportunities?
Yeah, I mean, so we do ours in house. So I mean, we just basically I underwrote our own program. I just looked at all of our data over, you know, at the time, I guess 10 years of business and figured out, what would we have to charge in order to make this profitable for us. And it's an extremely profitable program. A lot of people don't have that level of risk tolerance, which I understand. So if you don't, then what you can do is there's lots of companies out there doing this now. So one of my favorite is a company called Lighthouse. Those guys are fantastic, great contributors to the industry. Obligo is another one that a lot of people use. But I mean, there's literally probably a dozen plus security deposit alternative providers out there. If you just search for them, you can find one that works for you. And some of them are insurance products, some are financial services products. I mean, there's a lot of different ways to do it, but there's a lot of options. So, I mean, pretty much wherever you are, you're probably going to be able to find something that would work for you.
Yeah. Okay. Thank you. Thank you. Adam, anything to add on the SDA conversation, or shall we carry on?
I'm not keen on like kind of breaking the barrier there in Utah. I know that there's a couple around me that do it. I will say that my experience doing SDA on the insurance type setup that Todd was mentioning, it did not go very well for me. So I'd be very conscientious of joining anyone in that realm.
Yeah.
In-house is the way to go. Just get your actuarial needs right.
Yeah. Okay. Good deal. All right. This is a question that I had for you guys. I know it's rather specific, but I'm curious to get your take on this. So, Rick says, talk to me like I'm two. How does an SDA work? We'll do that in just a second. I want to talk about this. If the market stays like this for another 18 months, which business model breaks first? I think about this all the time. The different ways that you can, and I should have included a slide on this, but I'll just verbalize it. The different ways that you can structure a property management company My brain thinks in like Profit Coach dashboard version. So I think about the different benchmarks and the big six KPIs. You know, a common misbelief, I'm going to go off for just a second here. A common misbelief is that you need to be benchmark in everything. That when we say, here are the big six, you need to nail them all. RPU, DLER, churn, like all the way at the top. That's not true. You can have, and I had, a high RPU, high churn business and with a decent DLER. You can have a really high DLER business with a moderate RPU and a very, very low churn. You can have all of those things. So thinking about the different business models you can have in PM, since both of you guys know a tremendous amount of property managers and how they run their business, what breaks first if this doesn't stop? Start with you, Todd, again.
Well, I would say obviously it seems to me that if we're going to have pressure on ancillary fees, the companies that are going to suffer the most here are the ones that have a very poor DLER. If you're highly dependent upon labor costs, those are very difficult to get rid of. Unless you're super good at automation, it is, labor costs are typically somewhere around 40 to 50% of a property management company's total
Right.
costs, and that is brutal. If you are in a situation where you're starting to have ancillary fees taken away from you, like in Colorado, for example, where they're starting to outlaw these fees, if you're sitting there at a 10% profit margin and you have high DLE, you got a really poor DLER, you're highly dependent upon that labor. When that margin shrinks, what are you going to do at that point? You're in a very, very bad situation there. The companies that are going to be okay are the companies that have used Profit Coach and gotten their margin up to 30%. And they've got the buffer. So if they start to lose some of these ancillary revenue opportunities, they've got room to pull back, and they're still profitable. They're not going into the red. The companies that haven't focused on that efficiency are the ones that are going to have the biggest problems, I think.
Yeah, yeah, that's good insight. Adam, how about you? What's your take on this?
Yeah, I mean, first of all, we've had a really great run, right? It's been a banner, 5, 6 years. So hopefully you have money in your war chest. But that you also haven't just like let your foot off the accelerator of looking and scrutinizing your own operating costs, DLER being a major one of them. If it's not high enough, then you're looking at some painful days ahead. I'm a big fan of Disneyland, and I've looked at them, redo their ticket and pricing model at all of their resorts, and and they are now forecasting their labor based off of the number of attendees that are entering in the park. And so I think those people, those property management companies that can forecast out their labor for the summer, that can work with agentic AI and things of that nature, they're going to do that. But I don't think it's also going to be an absolute race to the bottom. At some point, I'm going to be like, I'm not doing property management for that fee. Or I'm going to say, I really hope, Mr. Customer, that you don't want to get a human on the phone because I don't have the margins in order to be able to afford that. So there is kind of a bottom floor and a top floor that we have to factor in. If things got tough, I would start removing some of the perks. So I'd also start looking to grow insurance captives or growing vertical, buying the painting company, and honing in on my vertical integrations in order to still maintain that moat of customer service and a lot of the incumbents. So like everyone's signing up for all of the software. So I'm signaling to all of these software providers that if my margins shrink, I hope that you can, work with me on that as well. When, the hog gets high, like by all means, let's all make money. But I'm kind of signaling saying you're going to have to reduce your operating costs. And a lot of that is renegotiating with your vendors as well.
Yeah, that's a good take. I think expectations, I think both of you mentioned this, and I believe that this is a good thing to verbalize, which is it has been an incredible run. It's not over. Like I was obviously joking about should we just throw in the towel and pack it up and take our ball, go home, get in another industry. But that is to say, if you did have a ton of success in the last few years and you do have a profit margin in the 30s and you lose some margin from this, at least temporarily, your hiding place, the place you're falling to is still a healthy place. You're sitting in the 20s, maybe in the mid 20s or even the low 20s. For a service-based business, that's still a good margin. You can still make good money from that. Hopefully, you didn't spend every penny that you earned in the last few years. If you're just getting in the game, it's a little bit harder. You have to find ways to make a competitive advantage. You have to find other ways to make money. Atom verticalizing is a really good idea. There's all sorts of things you can do adjacent to a property management company. If you can only manage a 15, 18, 20% margin in this company, you can do these adjacencies. So lots of options. Todd, anything else to add on this?
Yeah, I mean, while Adam was talking there, he was talking about, having to reduce some perks and those sorts of things might be something you have to do. And I mean, the first thing that comes to my mind, we have differentiated ourselves on our guarantees. That's always been how we've kind of set ourselves apart in the Atlanta market, which is a very crowded market. We've offered things like property damage guarantees, lost rent guarantees, and those things would have to disappear. There's just no way around it. If we started to lose some of this revenue, that's the first thing that has to go. I mean that means we're going to have to find another way to differentiate ourselves in that case. So, if these problems do continue, like it says, if the government keeps pushing for the next 18 months and making headway on this, then there'll be a lot of changes the companies will have to make, I think.
Yeah. Yeah, 100%. Okay, I got another poll for you. I want to move on to our next topic. What percentage of your revenue per unit comes from ancillary fees versus base fees? I'm not going to make you give an actual percentage here. Is it mostly base? Is it a balanced mix? Is it majority ancillaries? I said mostly, but I just mean majority. And then those of you in the last category who aren't sure where your revenues are coming from, you're just like, here's my revenue each month. You would select that last category. Okay. All right. Here's why I say that. This is interesting. This is from the 2022 benchmarking study, so it's a little old, though our newer data indicates that the shift has not changed all that much. Or excuse me, the ratio has not changed all that much. What you're looking at are across the top, those are RPU brackets of the most profitable companies in the industry. And then in the second two lines, you're looking at the percentage of fees just broken in half between management and ancillaries, two categories. And you'll see that as you get to the more profitable companies, a higher percentage of the revenue is made up of ancillary fees. And that makes sense because base management fees are not that variable. You've got some flat fees, you've got some percentage fees. We're not usually allowed to talk, although this is not an official NARPM event, but not usually allowed to talk about industry standard. But you know what they are, those percent-based management fees, and the spread on those is not that high. So the conclusion when you look at this is if I want to make more money, I have to charge a higher percentage of my fees as ancillary fees. So I'm going to end the poll and show it to you real fast. Most people here are on the mostly base fee side. They're probably somewhere based on just what I see in my daily life, somewhere between like 60 and 70% base fee is where a lot of people are. A balanced mix is great. That's where you need to be. You need to be somewhere around 50-50 or 60-40. Mostly ancillaries, those are the true killers. They're probably making a lot of money. And then not sure, haven't broken down. My encouragement to you would be run the reports in your PMS, in your software, and get that breakdown. Even if you're not dragging all of that over to QuickBooks or to your accounting software, which I definitely recommend, but even if you're not doing that, at least set up a monthly report so you can see the percentage that's coming from each. Okay. Just wanted to do that in order to contextualize. Sorry, did one of you have something to say? Okay, sorry, I thought I heard something. Okay, well, here's Adams. Nestwell is 57% base management fees. I know this because of my Profit Coach dashboard. Oh, thanks for the shout out. Appreciate that. Okay, let's talk number two here, the relationship between fees and trust. So this is a little less, here's exactly what I'm seeing and a little bit more. Here's how I'm feeling about my relationships with my owners based on these conversations, contextualized with a little bit more data. Here is the Buildium State of the Property Management Industry Report. I appreciate all of these different folks putting out these reports. They're super interesting. Property managers' top revenue growth tactics. So this is what PMs are saying they're going to do to drive revenue. Raising rents without property updates, We just looked at the data that shows that that is going to be probably fairly difficult. Increasing fees for residents, also probably fairly difficult. Increasing fees for owners, also facing some headwinds. So these non-highlighted are just kind of my identification of areas where you're providing additional value and increasing fees, which feels like the way to go right now. But again, there's a lot of PMs out there who are like, I'll just raise my prices, I'll just raise my fees. I think that's going to be pretty tough. Okay. But my question to you, panelists, and my chat friends, how confident are we that fees drive churn? We just talked about friction. Now let's talk about churn. And do we have any data to prove it? So, Adam, how confident or not confident are you that fees, additional fees, increases in fees drive churn?
Churn, as in owners terminating us
Yeah.
or tenants
Yep. Yep.
terminating us?
Owner
Owners?
churn. We could talk about both tenant churn and owner churn, but I was specifically talking about owner churn.
Um, I don't have any empirical data. We're doing NPS, one-star reviews to get, feedback, resolution times, exit interviews, failed onboardings is one. And if I was to summarize that, I'd say, yeah, I think fees are a factor because there's probably a misalignment of how expensive we are versus the value that we brought. But that's anecdotal, that's a feeling. But that's kind of the world that I operate in. I mean, maybe Todd has something that's a little bit more empirical. Um, but I can tell you that, like, I can have a 5-star experience at McDonald's and I can have a 2-star experience at Capitol Grill or the nicest steakhouse. It's a perceived value thing for me. And I can also say that we are bringing on fewer doors, and our business development team is saying there's some price sensitivity happening, and we're reevaluating our upfront fees to help get more doors under management.
Yeah.
And so those are some things that we're actually doing, but it's more data versus empirical.
Yeah. And then
Or,
how about on the tenant? Yeah. How about on the tenant side? Are you seeing I know that you're a little bit removed from the day-to-day of the application process and the tenant side, but based on what you know from your team, how much is your team saying, I can't lease this property because no one will pay the fees, or this is on market for too long because it's too expensive with all the fees? Are you hearing that sort of feedback, or is it mostly other factors?
yeah, our leasing team definitely is, tackling that. What I have heard through the grapevine from them is that during the slow season, being in Utah, it's very seasonal and holidays, everyone goes into hibernation, is that they're waiving application fees, they're offering weeks off rent, and instead of, hey, we're just reducing our fees, we're giving teaser rates, hey, 6 months free. I own properties across the entire country, and I have deployed and told all those property managers saying, you're welcome to do teaser rates or discount it. To Todd's point at the very beginning, is reduce the cost to get into the home, and then slowly boil the frog or go back to market rates. And so offering discounts or teasers or incentives up front is able to increase occupancies and reduce days on market. So those are some things that we're blocking and tackling.
Okay. Okay. Todd, how about you? Let's go owner side first and then tenant side. Um, are you feeling the churn? Are you hearing owners reference fees when they churn, or is that not a huge deal for you guys right now?
We haven't really seen it. I mean, we kind of do the same as Adam mentioned. We have exit interviews, surveys, those sorts of things that we're doing. And I'd say maybe of owners who churn, it might be one out of every 20 or 30 who mentions cost as the reason that they've churned. Usually it's because they're selling the house or, we had to evict the tenant or something like that. It's very rarely are they mentioning our cost of our service. Now, on the other hand, if we look at other data, so I mean, you'll remember a couple of years ago, Jordan and Peter put out
Mhm.
a report where they had surveyed a bunch of owners, and it's very weird because when you look in the data in that report, what it says is the average owner thinks property managers are too expensive, but then the average owner also thinks we charge a lot more than we do. If when the question was asked how much does it cost to have your property managed, most of them were estimating something like 5% more than the actual cost is. So it's
Mhm.
kind of a perception issue more than anything. And when you actually have the client, once they're signed up, it doesn't seem to be something that's causing any sort of consternation. The churn isn't coming from that I've seen. So, I think it's more of a biz dev issue than it is a churn issue when it comes to cost is kind of the way I look at it.
Yeah, I think you're right. I'm curious. I think you wrote an article on this, but I'm just curious to get your thoughts live. Um, Owner perceptions of what things cost versus what they actually cost often can come from a detailed list, having to see a review, a detailed list of all of the different fees that they might potentially be charged. This leads to a consideration in a lot of people's minds, mine included, of an all-in management fee, a one price, 1%, a single percentage that includes anything that might ever happen. What's your take on that?
I think it's a business model that makes sense. I think you just have to, you can't shoot from the hip on that. There's a lot of
Yeah.
property managers who don't have a good sense in their mind of exactly where all the revenue comes from. And if they tried to just spitball what that number is, they'd probably be wildly off the mark as to where they need to set it. So you have to actually have the data. If you're not on something like the NARPM accounting standard where you can break this stuff all down, and if you don't have your fees as sub accounts so that you can see what all this revenue is coming from, it's very difficult to figure out what that all inclusive fee needs to be. But if you can do that math and figure it out, I mean, it's just like Adam mentioned with Delta. I mean, Delta has, your Delta One rate, and they also have your basic economy rate. I'm the guy who buys the most expensive ticket there is on Delta when I fly, but there's a lot of people who aren't like me. So, you can set up your pricing model to where you're kind of geared towards every different person. That's kind of what Delta is doing now and how they're setting up all these different rates. So you can do that. But I would say if you're not going to do that, if you're going to go the all-inclusive route, you got to keep in mind there's a whole lot of the market out there that's not going to really like that sort of pricing model. So you got to keep
Yeah.
that in mind.
Here's a model test on the fly. What about an all-inclusive model that has tiers? So you have with this percent management fee, you get all of these things. With this percent, you get all of these things. And with this percent, you get all of these things. There are no ancillary fees. So you still have the choice, but there's no fee schedule. Have you seen that?
I haven't seen it, but I mean, I like the idea.
Yeah.
I mean, I think that would easily work if you, like I said, you just got to have the data. That's where all of this kind of falls apart for the average PM is, I mean, as well as I do, Brad. I mean, every property manager you talk to doing an initial consult, most of them don't even know what their ARPU is. So,
Correct.
if you don't have that basic info, you can't figure any of this stuff out.
Yeah, it's true. So that's a good pitch. What Todd and yeah, I'm coming to you, Adam. What Todd is talking about, the NARPM accounting standards, whether you use us, we wrote them, whether you use us to get on them, which I recommend, or you don't, which is also fine, you should get on them because they do make this math really easy because the granularity makes it highly visible to you. So Adam, you had a comment there. Go for it.
I thought your business idea was going to be doing like, if I have toyed with the idea of doing Nestwell Light. So here's our
Yeah.
full stack, but I have an
Mhm.
alternative brand. So like Ritz-Carlton has their high-end brand, but then it slowly cascades and you lack amenities, services, etc. Like I think maybe there's Nestwell Light or Revolution Management Light, where it's like, hey,
Mhm.
you don't talk to anyone. We do these basic features. And maybe that's just like a price anchoring saying this is our lowest tier. I know a lot of us have tiered pricing and we're really trying to push them up to a full service. I don't think I could do it because fundamentally I like nice things and I could never offer a less quality service in my mind. It's just incongruent, but I think there's opportunity there.
Yeah. Yeah. That's funny. Good for you. Good for you on that. But yeah, I think there are ways to kind of marry both of those worlds. So if that catches on and becomes a new industry standard, please remember this program, these gentlemen, this is where we came up with it. Okay, moving on. This is a great diagnostic question for you. What indicators tell you you've crossed the line from healthy margin protection into value erosion? And what I mean by that is how do you know, Claire Pitcher right here, she basically just asked that question in a more simpler form. How much is too much? How do you know when you are driving too hard on the ancillary fees for the sake of revenue per unit, the sake of profit margin, and you're actually eroding your value proposition? Um, Todd, go for it.
I mean, it's a free market thing. I mean, the market speaks. Listen to it. That's what it all comes down to. I mean, if you are hopefully tracking things like your biz dev metrics and your churn rate and all that kind of thing, and then you add some new fees and you see some negative implications in that data, the market's told you something. The market said this isn't going to work. The people are pushing back. They're saying this isn't going to work for what they think is good value. So that's why it's so important to constantly track this stuff so that you can see those trends, and you can put an indicator right on your chart and say this is where we made this change and how do the numbers impact going after that. That's what you need to do. And you need to be doing things like surveys. We do new tenant surveys, we do existing owner surveys, existing tenant surveys, just asking them these questions. Just ask them flat out, what do you think is fair? The reality I always tell people is it doesn't matter what someone thinks is fair, it matters what they're willing to pay. But still, that data matters. Getting that feedback from people matters, because if you do need to pull back on some of your fees, you want to target the areas where people really aren't happy with them, instead of just kind of guessing as to which fees are going to be the best ones to pull or to reduce. So data is king. I mean, that's what I would say for all this.
Yeah, yeah, that's good. Adam, how about you? How can you tell?
On owners, yes, the metrics matter. But I'll make it a bumper sticker. I would say if a homeowner's taking back a property and they, on the exit interview, or you just ask them, hey, why are you firing me? Say you're too expensive. That's probably a signal. Or the inability to attract new business and then convert it. So I have no problems attracting new business, but the conversion, and if I'm losing people out due to price sensitivity, those would be my two indicators on homeowners and new clients. On tenants, I would say if they are moving to another rental because of move-in incentives, that those would be my three things that I would want to track and or know.
Yeah, that's really good. One thing that I would say here is I think because of I know this for myself because I watched this happen while I ran a management company. Because of the boom and because of how great of a season we were in, I think salespeople got a little lazy with the value propositions because it was a bit of if you build it, they will come. If you have a decent management company, there are leads, you will capture them, your company will grow. And then, of course, such a supply side issue on the housing part that, if you have vacancies, they will be filled. So I would say now is also a great time if you are the BDM or if you have a BDM to really equip yourself or equip your salespeople with the value proposition arguments of your entire fee schedule. They should know, they should disclose it. Stephanie made a great point. If you are a smaller operator, you have an opportunity to take market share from some of the larger companies, especially some of the nationwide brands, especially those who have just recently entered into those portfolios. There are opportunities for you, but you have to be quick to disclose and be transparent and know not the argument, but the value proposition. This is why we do this. It creates this value. This is why we charge for it. That is a really helps eliminate a lot of friction on this topic. Okay, quick example. What's one fee you've seen quietly damage trust? Not necessarily through outrage, but through slow disengagement. If applicable, is there something that you've tried and then stopped, or you're seeing in the data, in the patterns that is making life difficult for your owners or tenants? Adam, you're nodding your head. What you got?
Oh yeah. Anything that has to do with maintenance. We do NPS surveys
Yeah.
and we're around 55, 65, right? Um, and 80% of the detractors, when they were asked for feedback, it was around maintenance markups, maintenance fees, etc. So all things maintenance. If I had to choose one though, it'd probably be the maintenance markup based on a percentage. I don't care if it's already disclosed, but you're already kind of like taking a chunk when they're already down. So it's like I'm getting my pound of flesh while I facilitate this. The way we do it is a flat fee to facilitate a repair once we dispatch a homeowner. And I just feel like that's a little bit more equitable. So I'll hang my hat on that.
Okay. Yeah, maintenance side. Todd, how about you?
Yeah, I mean, you and I talked about this before the call, and I had the same answer, was the maintenance markup. I mean, that's clearly the one where it's really easy to make an argument that there's a misaligned incentive there. I mean, I don't even argue with an owner when they say that they think it's misaligned. I mean, I understand what they're saying. at the same time, we got to make money on maintenance somehow. So you got to find a way to do it. It's just a matter of how you do it. Aside from that, what I would say is a fee that I'm a huge fan of. It's a huge portion of revenue for me and my business, and that's what we call credit contingency fees, or what some people call risk mitigation fees, which is basically a fee you charge to a resident whose credit score isn't ideal, basically, and you still allow them to rent. That will sometimes, if you don't educate the owner up front as to what that actually means and what that's there for, and the fact that you're not reducing your actual criteria, then owners, when they see that come through on a lease, it can really give them some heartburn. They'll look at that and say,
Mhm.
"Oh, you had to charge this tenant some extra money because of their credit score. Why did you rent to them at all?" And if you're not teaching them up front that, oh, we still have the same criteria, we still have the same scoring, we're still running the same application. This is just the people at the lower end of it. If they don't understand that, that can really create some friction and some mistrust. So you got to be careful with anything like that. Same thing with security deposit alternatives, by the way. That's another one you really need to educate your owners on, because that can lead to some just a little bit of mistrust in how qualified is this tenant really if they need that.
Yeah. Yeah. And the what's crazy, and I know that you talk about this a lot, is that you can have a fairly decent job, a decent income, meet all the criteria, but just not have, especially if you're younger, not have the cash reserves to come up with security deposit. That doesn't make you a risky tenant. It just means you don't have 4 or 5 grand laying around, and that's a thing.
Yep.
Yeah. Can you explain credit contingency fees just for a moment so that everybody kind of knows what that is?
Yeah, sure. I mean, basically, it's the idea that, at least the way I teach it, the tenants who fall in the bottom half of your approval criteria are the ones that I would charge an additional fee to. And the basic idea there is these are the people we all know, even though they qualify, they create more work for us. The person with the 820 credit score that makes $400,000 a year, I will probably never speak to that tenant the entire time they're in the property, and
Right.
they'll leave it looking pretty damn good. On the other hand, the tenant who has the 620 credit score, and they're probably going to pay late more often. They're probably going to cause more maintenance issues. They're just more work. So it's kind of compensating us for the additional work on those, because a lot of the cases, if you're charging a percentage-based management fee, those are usually the properties where you're collecting the smallest management fee on, because they're usually lower rent, but they're the highest amount of
Mhm.
work. So it's kind of making up for
Yeah.
that, especially if you're like us and you manage C-class properties.
Yeah. Yeah. Absolutely. Okay. All right. Let's move on. Before we do, I want to offer some of our team's time here and say this. So, going to throw a poll out there. If you would like some help, we would love to schedule a strategy call with you to evaluate how your fee structures and your retention efforts fit in with your long-term business plan. So we'll throw that poll on the screen. Just select yes if you want to chat with us. What that will look like. Also, by the way, you can just, if you're watching on your computer, you can pull out your phone, scan that QR code, go straight to a Calendly link to talk to our team. During that strategy call, we will help you get clear on the RPU you need to reach your financial goals. Like I said, that's not negotiable. There's still a number that you have to have on the revenue side in order to get to where you want to be on your profit margin and on your bottom line profitability. It's not a matter of will I do ancillary fees? It's what are they going to be? How much are we going to charge? And how does the model work? You have to know that number. Identify the fee structures that best align with your needs and value proposition. As you know, there is a lot of different things you can do. We talked about many of them today. What works for you? That's what we're going to talk about in a minute after this as well. And then pinpoint the revenue streams that can get you there and what they mean to your bottom line. So, really honing in on the revenue side. Would love to do that with you. Ultimately, be able to create a plan to implement those strategies for you as well. So, scan that QR code. Would love to chat with you. No pressure to buy from us on that call. Want to be able to provide value to you. If it's a good fit and you want additional help, of course, we'd love to help you as well. So, thank you so much for that. And now, number three here, designing the business you want to run, building for scale versus building for fit. So, let's start with you, Todd. Think about your best owners versus your most difficult ones. What's the biggest difference in what they expect from you? I'll leave that nice and open-ended for you. Best and worst,
Yeah, I
like
mean,
how are they different?
Well, I mean, I don't think anybody who knows me would be surprised by this, but I want the owner who I never have to hear from, who's just happy to let us do our job. That's the owner we're looking for, and our fee structure is kind of based around that. You know, kind of fitting in today's discussion is the idea that if you take up a lot of our time, ask us to do a lot of stuff that's not our standard way of doing things, it's going to cost you more money, which is kind of how we try to push that client out the door. So, you know, we're trying to focus on the owner who looks at us the same way I look at my mutual fund manager, where I give them my money, I let them decide what trades they're making, and then I don't have to deal with it. That's the kind of client we want. So we try to design the entire business around that idea, basically.
Yeah. Yeah, that's good. Adam, how about you?
Um, our ICP, ideal client persona, is long-term real estate investors who are hands-off, looking to grow their portfolio and leverage their time. If they're looking to leverage their time, they say, Adam, take the wheel. And with that being said, there's probably not that many people in the state of Utah that fit that right now, but we're getting a lot of leads. And so we have this opportunity to like serve and educate them and turn them into our ICP. But the way I was thinking about that question is like personality traits. So someone who's mistrusting, um, gives us won't give us autonomy. Um, they're dictating, they're controlling, they're intense. I just don't do well with intense personalities. They ask for special requests. All of that are kind of like non-starters. Tony Klein gave me, I was in a mastermind with him a decade ago, and he gave like a five-star property analyzer tool, and it also analyzed their personality traits. And it was like proximity, personality, price, property, like would I be willing to live in that property, and then phase. So it's five P's.
Mm.
And that has served me really well. The type of client that I really do like, very trusting, autonomous, respects our craft, who we are, doesn't treat us like an employee, financially stable, calm, logical, fair, equitable, caring. That's who I would love to do business with.
Yeah. Yeah, absolutely. Okay. Keep rolling here. Coming up on time, but want to get through a couple more questions here. How do you decide whether a client is buying peace of mind versus lowest cost? So, like, how do you suss out in that process what your owner wants from you, and how at all, if at all, should that change your pricing model? Adam, I'll throw that right back to you. So, how do you decide if a client is buying peace of mind versus lowest cost, and whether or not they'd be a good fit for your model?
Yeah, our biz dev team does a pretty good job sizing up companies, or excuse me, potential clients pretty quick. And they asked a couple of questions. Um, the survey is, are you an ounce of prevention or pound to cure type person? Um, are you willing to, invest 15% of your revenue back into your property to maintain a certain caliber, or attract a higher end resident? Those are like the two main questions that we like to ask them. And we kind of treat when the phone rings and we're getting inquired about our services, we actually are like, we're actually interviewing you. And we ask them a lot of questions to kind of get a feel for them.
Yeah. Yeah. It's two-way, definitely two-way street. Todd, how about you? How do you suss this out in your sales process, prospective sales
Yeah, I
process?
mean, I think the question that would help the most with this is something that Rent Scale and PM Path Builders teach, which is ask them what's your long term goal with this property, and then just let them talk. And they're going to say something, and it could be all over the map. If they start talking about their ROI, then okay, this is someone that we really need to focus on what their actual monthly cash flow is going to be, and we might need to get this person to a lower price tier on our plan because they're going to care about those sorts of things. On the other hand, if they tell us, well, we just want to have this house cared for the next 5 years so we can move back into it, okay, that's someone who cares about peace of mind. That's someone we need to offer the guarantees to and make sure that they just feel comfortable being a landlord, because that wasn't their goal. That's not what they're here for. So, I think that question really, and it just really opens them up to talk for 5 or 10 minutes and get a feel for them. And I think, I'm not a sales guy. I'm always the first person to tell you that. I couldn't sell anybody anything, and I don't want to. I do not like sales, but I find that does work really well for figuring that kind of stuff out.
Hmm. Yeah. Yeah, that's a good one. Okay. I believe this is our last one here. So can a company realistically, kind of in summary, not that this has been everything we've talked about, but we've talked about these models. Can you be high touch and low fee at scale? Like as you grow your company, can you be both high touch and low fee, or does something always give in the model when you're talking about the ability to provide an extremely high level of customer service, or maybe just a very high level of customer service, and have a fairly low fee model. Either I'll open this up to either one of you. Like, how do you relate to that question? Do you think that's possible?
Well, my answer used to be something has to give. It's always been the idea you can fast, good, or cheap. Pick two, and that's what you can get. You can't get all three. And I'm not sure if that's in the case anymore because of AI. That's
Mm,
where I think the difference might be coming into things, where you might actually be able to create a very high touch environment because you can take your human capital and use it just for talking to owners and just for talking to tenants, and all of your day to day is just taken care of by the tech. If that comes to fruition, which is what I'm spending a lot of my time doing right now, trying to figure that out, then I think it might be possible to do it. But I think it's kind of up in the air at this point, I think.
yeah, yeah, for sure. I have appreciated your honesty and transparency as you've gotten into the AI sphere a little bit more, and I think you've got a good perspective on it. So that's been good to watch, good to read. Adam, how about you?
Um, you know, Todd said it so eloquently, and my thoughts were the exact same. There's the trifecta, right? Good, cheap, fast. I will say if I'm looking at brands that I adore, Delta, Porsche, Ritz-Carlton, Disney, a lot of them, if they can deliver a great experience autonomously and I can just kind of self-serve, that's great. That feels really good for my generation of people. And if I can get even more out of agents or AI and stuff like that, I can resolve my own concerns. I'm very satiated. I will say when I am paying a lot of money and I do not have the quality of service or the perceived value, then I am really, really upset and I will take my money and go, elsewhere. And so I think just finding a marriage between who you want to be. And I think that's at your core. If you like nice things, but if you're a very frugal person, then create a very frugal business and tailor your customers or your ICP around your business and attract that because there is something for everyone and pricing models for every type of property management company. If you want to be white glove, low cost leader, there's optionality there. But to Todd's point, AI might hijack that good, better, fast, or sorry, cheap, fast, good.
Yeah, yeah, that's really good. Man, I had a thought on your thought and it escaped me. Um, shoot.
We're all getting older, Brad.
It was right there. It was right there. I guess it'll have to wait for next time. Okay. Well, that's going to do it for us. Before you go, you can find Adam on LinkedIn and wherever else he feels like being. I know he's on Crane. You can poke him on there if you're part of that. Todd, PM Assist is a really good resource. So if you're not subscribed to Todd's newsletter, you really should be. Go check out PM Assist. They have all kinds of great data and information and helpful things that you can either see for free or purchase that will help you in your business. So that's how you can follow those guys. There it is, pmassist.substack.com. Thank you guys so much for joining us, and we'll be back at the end of March and look forward to seeing you there. See you later.
See you guys.